Today I will be giving a brief overview of the secondary mortgage market. To begin, it is important for us to understand the primary mortgage market. The primary mortgage market is where loans are originated. When a potential home buyer needs a loan, they go to a bank and receive approval and financing from that institution to purchase the property. These transactions make up the primary mortgage market. So what is the secondary mortgage market? It is a marketplace where mortgages are bought and sold. The mortgage lenders sell the financed loans to interested investors. Participants in the mortgage market include the mortgage lender. This could be the bank or other companies that finance loans to people who are purchasing property. The other participants in this market are investors. Some types of investors would include insurance companies, hedge funds, and pension funds, to name a few. So why do lenders sell the mortgage loans rather than keeping them in-house? Mortgage loans typically have a long life of 15 to 30 years. Large loans with that long of a life tie up a lot of money for the lending institution. Before the creation of the secondary mortgage market, only large institutions were able to handle carrying a loan throughout its lifetime. This meant that there were fewer options, and home buyers had a much more difficult time getting the financing for the purchase of a property. The secondary mortgage market made it possible for smaller institutions to finance loans and then sell them to investors. This freed up the institution's cash, and they were able to finance more loans. In 1968, the Charter Act was created to solve the problem of lenders not being able to finance large numbers of loans. Fannie Mae and Freddie Mac are companies that the federal government sponsored to buy and sell mortgages to investors. Buying a single mortgage can be a risky investment, so multiple mortgages are bundled together in mortgage-backed securities to reduce the risk to the investor. The secondary mortgage market solved a problem. Lenders now had the ability to finance a larger number of loans. But the solution also created a new problem. Since bankers and mortgage brokers weren't going to keep the loans in-house, they no longer had any skin in the game. They weren't worried about homebuyers defaulting on their loans because they knew they could sell the loans before a default happened. They began offering riskier and riskier loans. In 2006, housing prices began falling, and homeowners were finding themselves upside down on their mortgages. Rather than making payments on a house that was no longer valued at the price of the mortgage, homeowners foreclosed. This was a disaster for the secondary mortgage market and the country. In reaction to this crisis, the government spent billions of dollars bailing out Fannie Mae and Freddie Mac. This may have prevented a complete collapse, but it didn't stop the enormity of the crisis. The economy went into a recession for several years, and home prices continued to drop. It wasn't until 2012 that the market recovery reached its 2007 numbers. So what is the current situation? Well, it is much harder to get financing for a loan. Lenders are much more cautious and require documentation from potential applicants that prove they will be able to keep up with their mortgage payments. Having a more difficult lending process may be a nuisance to the applicants, but it is an important protection for the market. The housing market is rising again. Hopefully, lenders and the secondary mortgage market will continue to show caution and avoid mistakes that could lead to a crash similar to the 2008 crisis.